And welcome back to the Lance Roberts Show podcast. Our guest today, Danielle DiMartino-Booth, CEO of Quill Intelligence and the author of The Daily Feather. Danielle, just for the break, we were talking about the Federal Reserve, the market confidence in the Federal Reserve. I have a bigger question. The markets have become, after a decade of an advance in the markets, and seemingly no matter what happened in the economy, whether it's an emerging market issue, as a Brexit issue, markets just continue to go higher, successive round after successive round of quantitative easing and different maturations of liquidity in the market, 0% interest rates for a decade nearly. One of the beliefs by the markets is that don't worry, everything's fine. Even if we have a 20% correction in the market and maybe even a small recession, the Fed's got it covered. They'll just drop rates back to zero and they'll just start doing QE all over again. Here's my question to you. In 2009, when we started this grand monetary experiment of quantitative easing and low interest rates, the Fed balance sheet was about $900 billion. Interest rates on the Fed funds rate was about 4.5%. We expanded that balance sheet to $4.5 trillion. We lowered interest rates to zero. And yes, we got a booming stock market out of it, and we got an economy that grew at about 2.5%. Here we are today, though. Interest rates, we seem to be at a sticking point in terms of hiking rates here. The Fed is concerned they cannot hike rates further from here at 2.5%, 2.4 to be exact, but say 2.5%. The Fed balance sheet still over $4 trillion. So even if you do restart QE at this juncture where the markets are, the markets in 2009 was the abyss. Everybody was convinced the world was over. The employment was at double-digit rates. Everything was bad no matter where you looked. Today, confidence is high, employment at record lows, unemployment at record lows, jobless claims at record lows. Everything's about as good as it can get. So even if you started QE here, and even if you did start, lowering Fed funds rate, it seems to me that the ability for the Fed to backstop the markets and the economy soon is very limited. The efficacy of their ability is limited because you don't have the blown out scenario that we had back in 2009 that was begging for some sort of support.
That is exactly right, Lance. That is what I've been trying to convey to people. It's not a matter of the Fed being unwilling to revisit the emergency toolbox to go back to unconventional monetary policy. It is the process of what it takes the Fed to get there for there to be any kind of efficacy. Again, none of this is going to happen overnight. And I think that it is, I think for there to be an assumption that we're going to go down to 3.6% on the unemployment rate, whenever we've been here historically, whenever we've been as stretched as we are today, 12 months later, it has not been pretty. But that's what happens when you stretch a rubber band too far. So I think that there are two separate matters about. One of them is there's only so much that the Fed can buy and buy quickly. They're trying to get out of the mortgage-backed securities game. Mm-hmm. They're trying to make it into a simpler, kinder Fed that just owns short-dated treasuries. Well, guess not. That's not how QE works. Right. It's not how QE can work. People have to understand that starting points matter. So if the Fed was to start QE tomorrow and start buying up as much as it could and try and bring long-term, long-dated treasury rates down, because that's what we, as households and corporations, that's what we key off of, that's what we borrow off of. People don't understand how very shallow that pool of securities is to buy in the first place. And then you're at a slippery slope. And again, where confidence takes a hit and you're talking to Congress about buying corporate bonds, about buying stocks, about buying municipal bonds as a Fed. And you have to ask yourself, where does that leave the rest of the world? Mm-hmm. With Draghi starting off with a balance sheet that's over 40% of Eurozone GDP, with the Japanese already infringing upon the ability of Japanese stock markets to function because they own so much of it. Right. Same with the Swiss. So I think, to your point, that starting points absolutely have to matter. And for investors to be under this illusion, to be delusional about the ability for the Fed to completely ride to the rescue before any real economic damage is done, when, by the way, China cannot reinvent an auto miracle that translates into a German booming economy. There are certain things that cannot be replicated right now. And I think investors are not discounting to a great enough degree the ability for the Fed to come in quickly and resuscitate the financial markets.
Well, I think that's a brilliant point. And one thing that as you're talking about that, I'm thinking in my mind, going back to our earlier part of our conversation, $1.5 trillion in leveraged loans, $4 trillion unfunded liability or underfunded liability in pension funds around the country. And I think, and when we talk about pension funds, I think that is really a risk that nobody really gives enough, attention to, because, in 2000, we crashed the markets, and these pensions are built on 7% return assumptions or 8%, whatever they are. So they were behind the decade, for a long time. In 2008, they crashed again. But now the difference is today is that we have more individuals on the brink of retirement today than we did back in 2000 or even in 2007. And I think the one underappreciated risk when it comes to pensions is that another big decline in the market eliminates or exacerbates, I should say, that underfunded status. And at some point, pensionees are going to go, you know what, I better get my money out because I'm not going to get it if I don't get it now. And you get a run on pensions. And I think that's something that potentially the Fed can't even backstop.
That is exactly right. And, you're in Houston, I'm in Dallas. Dallas is where we had our first instance of a run on a pension. Mm-hmm. Any pensioner that had the ability to access a lump sum payout rushed to do that at the first whiff of insolvency in their pension. You cannot have that happen on a large scale in certain states that are absolutely at the brink. And what most people don't appreciate about public pensions is that it is just in the third quarter of last year, the second quarter in some cases of 2018, that pensions recouped the losses from the great financial crisis.
Right.
Their portfolios didn't rebound near as rapidly as those as, say, the S&P index fund.
Right.
And so they're just now back to the starting point. This is the last thing they can deal with, and it's no longer an actuarial assumption and accounting gimmickry because, as you say, 10,000 baby boomers are retiring every single day, and a lot of them, because they're going into their 70s, not into their 60s, don't have the physical wherewithal to say, you know what, I'll sweat this one out. I'll stay in the job market for another decade. That's simply not an option for quite a few of them. So you're talking about public pensions having cash flow issues here. And in many cases, they could be more rapid cash flow issues than we appreciate because this has been the ticking time bomb that's never blown up.
Exactly. And I think people, you said something very important is that pension funds just got back to even a decade from the financial crisis. And then with return assumptions of 7.5% a year, that means that they're at least, not even counting compounding over the years, they're at least 75% behind where they should be on just the growth of the fund just in the last decade. So again, that the amount of underfunded issues with these pensions is so much larger than people realize. And when you actually take a look at the amount of cash and assets on their books, the underfunded status of these pensions is actually bigger than what's reported because the reported underfunded status still includes that 7.5% growth rate. So, there's the liability, the risk is probably even larger than we assume at this point. We're going to take a break. I want to come back and talk a little bit about some of the Fed. We've had Clarida out. We've had Brainerd out talking about various different things. I'd like to touch on the issue of targeting yield and also just basically turn it over to you as the CEO of Quill Intelligence to make sure that I didn't miss any good important topics here. We'll be right back with Danielle DiMartino-Booth right after the break.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.